Great entrepreneurs build valuable companies, but value only becomes real when the exit is planned and executed well. Today, we're talking about how to prepare a business for sale or succession so you capture true value instead of leaving it on the table. And here's the mindset shift I want you to take away. Every business owner should be preparing to grow or exit. Guess what? The same steps are needed to do both. So whether you plan to sell in 2 years, pass it to family someday, or keep building for the long haul, this episode is for you if you own a business. I'm David Stevens with Stevens Capital Partners. One of the most complex aspects of building long-term wealth isn't revenue growth, hiring talent, or product development. It's planning the end game. Business owners often say, I've spent decades building this. How do I make sure I capture its full value? I want to exit on my terms, not because I'm forced to. High-stakes exit planning combines strategic foresight, financial discipline, organizational readiness, and a lot of emotion. But let me frame this in a way that matters even if you're not planning on selling tomorrow. Everyone needs to be preparing to grow or exit. And the truth is, the disciplines that make a company easy to sell are the exact same disciplines that make it easier to scale, more profitable, and less dependent on you. In the book Walking to Destiny, written by Christopher Snyder, he uses a simple image I love, the three-legged stool. A great exit requires a balance across all three legs. The business, is it transferable? Is it valuable? The financial plan. Will the exit fund the life you want, net of taxes and risk? And then, of course, third, the personal plan. What's next? What's your purpose, your identity now? Time that you have that you didn't have before. Relationships, and the impact you want to make. Most owners obsess over one leg, the business, but if any leg is weak, the whole stool wobbles. So today we'll cover 3 practical areas that map directly to that framework: operational readiness, building transferable value, financial and legal housekeeping, or protecting net proceeds and deal certainty, and finally, the stakeholder alignment, so transitions don't stall and value doesn't erode. And throughout, I'm going to emphasize another key area. A large portion of the business value is tied to intangibles. In the exit planning language, that's the 4 capitals: human, customer, social, and structural capital, especially structural capital, which is the systems and the intellectual property that make it repeatable. Point number 1, build operational readiness and institutionalize value. One of my first questions to a buyer or successor is, can this business run without the founder? A business that depends heavily on the owner is riskier, and risk shows up in lower valuation, tougher terms, or delayed deals. This is where structural capital becomes a superpower. Documented processes, systems, intellectual property, scorecards, and repeatable delivery are all things that make performance predictable, even if you step away. Market surveys and deal professionals routinely point to a strong management team and lower owner dependency as major indicators of exit readiness. Here are some quick practical actions. Document core processes across sales, delivery, and finance, even HR and product service execution. Build a leadership layer with real authority and accountability independent of you. Establish objective performance metrics that show predictability and scalability. Stress test the business. Take yourself out of the key decisions and see what breaks, then come back and fix it. Bottom line, buyers want systems, not superheroes. When the business operates independently, confidence goes up and so does valuation. Point number 2, get financials and legal structures clean and optimized. Clarity in financial reporting and legal structure is foundational to a successful exit. If diligence uncovers messy books, unclear add backs, handshake contracts, or legal ambiguity, it usually leads to price reductions, dragged out negotiations, or deals collapsing. Owners who do structured preparation ahead of time typically move faster, reduce diligence friction, and protect value during negotiations. Quick practical actions. Number 1, clean up financial records. In other words, consistent reporting, reconciled accounts, and defensible EBITDA add-backs. Number 2, standardize customer, vendor, lease, and employment agreements so they transfer cleanly. Number 3, align tax structures for efficiency and minimal surprises at closing. Number 4, identify contingent liabilities early. Don't let them surface for the first time in diligence. The bottom line is a transparent financial and legal foundation speeds diligence and strengthens buyer confidence, usually meaning better pricing and smoother execution. Point number 3, align succession or sales strategy with the stakeholders. Exit planning isn't just operational or financial, it's deeply human. Family members, partners, executives, key managers all have stakes in the outcome. Without alignment on vision, incentives, governance even, and other roles, transition stalls and value erodes. This is also where the three-legged stool matters again. You can have a strong business, but if the personal plan is unclear or key stakeholders aren't aligned, owners end up delaying decisions and avoiding hard conversations. Therefore, exit happens to them instead of for them. Quick practical actions. Clarify roles and expectations with family, partners, and executives early. Number two, create governance, advisory boards, succession committees, or family councils where appropriate. Number three, align key talent incentives with transition success so critical leaders stay engaged. Revisit the plan regularly as business, market, and leadership dynamics evolve. The bottom line is alignment reduces friction, strengthens confidence, and protects value. So ask yourself these questions this week. What processes are known only by me? Where are the biggest gaps in my structural capital? My systems? Is it documentation, scalability, repeatability? Are my financials or contracts clean enough to avoid reduced valuation or slow the diligence process? Who must be aligned on the exit vision before we go to market? If I exit, what's next for me personally? And is my financial plan built to support that life? Exit planning isn't a one-off event. It's a multi-year journey. Success comes when owners institutionalize value, especially structural capital, organize the financial and legal foundation, and align stakeholders, while keeping the three legs of the stool balanced: business, financial, and personal readiness. And let me bring it full circle. Every owner should be preparing to grow or exit, and the same steps are required to do both. The work you do to make your company transferable also makes it scalable, more profitable, and less dependent on you. So if you own a business, this isn't just exit planning, this is how you build a stronger business starting now. If you found this episode helpful and want guidance on preparing your business for a successful exit or succession, contact Stevens Capital Partners. Our advisors help business owners plan strategically, maximizing value, and navigating complex transitions with confidence. If you like this episode, please subscribe or leave a review. Have a topic you want us to discuss? Drop it in the comments. I'm David Stevens with Stevens Capital Partners. Thanks for tuning in, and we'll see you next time.